Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
Well, I think it's a relatively solid number, and it offers an indication of still positive conditions in the labor market, helping to offset some of that rising concern that circulated through investors and the marketplace in the aftermath of a less than solid July employment report.
We always talk about, drugs that are used once patients have already been diagnosed with something. In this case, they're preventative in many ways. Plus, you get, 15 to 20% weight loss in less than a year. I just feel like so much more of the population is interested in this beyond just obesity.
The challenges continue, and linear television is still the biggest driver of this company's profit. And as we all know, that the pressure on the ecosystem, given cord cutting, given U.S. linear advertising challenges, is weighing on the company.
We have got 1 hour to go until the market close, so we're taking a look at the major averages here, Josh, and we are seeing a rally occur here, up 1.7% on the Dow, more than 650 points. The Nasdaq up 2.7%. I'm going to try and find the S&P 500 somewhere in here, but we are seeing the S&P rise the most. Initially, we were seeing it rise the most since February at one point during the day. Now we are seeing it rise more than it did in February here with this 2.22% gain. So it's the most in at least a year that we're seeing this climb here, and it's a broad-based gain. So small caps are up about the same amount there, which is quite interesting to see. And then if you look at the groups in the S&P 500, they are all up as well. Nothing but green on the screen here. It all got kicked off this morning with a better than estimated jobless claims report. Jobless claims not usually a huge market.
No, I know. The thing was that initial claims, and it was interesting because I saw some smart economists, and they kind of looked at that print. They said, you know what? To me, that's sort of consistent with slowdown, not brewing downturn, at least for right now. I think it is interesting, Julie, because you don't associate initial claims with like a market mover. But at a time when the question we're all trying to figure out is the overall health of the economy, it's also August, you're trying to grab it onto any data point you can right now.
And there's just not a lot of data this week. So that was the thing that people sort of seized upon. I will say the group that's doing the best today is tech, right? The XLK. That's also reflected in the strength of the Nasdaq 100. And you see an awful lot of green on this screen. I'm going to equal weight this for a second, because in the Nasdaq 100, there are not many. It keeps moving around on me. Less than 10, let's call it, stocks that are down. Everything else is up today within big cap tech.
All right, good day for the bulls. Let's get more on this. Latest moves. We're going to welcome in here Eric Ditton, President and Managing Director at the Wealth Alliance. Eric, it's good to see you. So I don't know if you heard Julie, we were talking there. We did get some economic data today, Eric, initial claims, another data point on the labor market as investors are trying to figure out, Eric, where this U.S. economy is and where it is headed. What do you think, Eric? What are you telling your clients?
Well, first of all, thanks for having me here today, Julie and Josh. And I made sure that today was a big update, so this would be an easy interview. So you're welcome. I actually think, look, Jay Powell wanted 2% inflation. Careful what you wish for. When you want 2% inflation and you raise rates 11 times, the economy is going to slow. And at some point, you're going to have to pivot. So we saw at the end of last week a number of really weak numbers. PMI manufacturing down 4 out of 5 months in a row, down 20 out of 21. And PMI services 76% of consumption turned negative into contraction. And that spooked the markets plus the payroll numbers. So I really believe Jay Powell should have cut last week. He didn't, and I think the markets are starting to get very comfortable with could be a 50 basis point cut in September. The Fed is behind the curve. There's not an imminent recession. We just had 2.8% GDP. Economy looks pretty strong. We're 4.3% unemployment. That's a very reasonable, solid number. But let's remember, it's almost 1 percentage point higher from where we were not long ago. So the trends are what are spooking the market, and the Fed needs to act.
Well, it seems like the Fed is going to act in September, right? I guess the question is, with the market up today, is the spooking done?
No.
So
no,
what does that
I
process now look like?
This is the Fed has said forever that it's data dependent. And not long ago, Jay Powell said, hey, if inflation is at 2% and unemployment's at 4.2, Fed funds should be somewhere around 2.8. Hey, we're north of 5. And we're at 2.5% inflation. So we're almost there. We're almost at his target. And we just ticked above his unemployment number. And he's still sitting north of 5%. So I don't think it really matters. There's enough in the numbers for the Fed to cut, and they will.
We're also in the middle of an election year here, Eric. Politics front and center. Trump, of course, speaking today. I'm interested, when your clients are asking you how you're thinking about that, as a market pro, as a strategist, what do you tell them?
Don't get caught up. First of all, there's no clear winner right now. So a few weeks ago, you really could talk about the Trump trade. Trump had just tremendous momentum versus Joe Biden, but obviously that's done. And Harris is a contender. So you don't want to make a bet on either side. Despite the volatility and the nervousness every 4 years, the election year tends to be a good year in the market. And the last thing you want to do, and I've had some client calls saying, hey, maybe we should just move to the sidelines. There's a lot we don't know. No, don't do that. Look what happened when Trump was elected. The markets had a big sell-off in the futures overnight, and by the end of the first day, the market was up huge. So you don't want to play that game, and we don't. Stay invested.
And so what do you invest in? What are you recommending clients stay invested in right now?
Yeah, so that's the tricky part here. We need to just look at what's happening in the market here. We have gotten incredibly concentrated. You've heard people talk about it, but understand that to have Microsoft, NVIDIA, Apple, 3 stocks out of 500 accounting for 20% of the S&P, that has never happened before. 5 largest stocks, 27% of the S&P. You go back to the tech bubble, and at the height, the 5 largest stocks were 18%. So we are concentrated. And what you want to see in a healthy market is diversification. So we actually go through long periods of what I call concentration cycles and diversification cycles. And they tend to each last around a little over 10 years. This concentration cycle is the longest in history. It's coming up on 18 years. So what we're not doing, we're not loading up on big tech. Do we own it? Of course, you have to own it. AI is real. Big tech is profitable. They're growing earnings fast. But you don't want to own it the way the S&P owns it and be that concentrated. So during diversification cycles, which we're overdue for, the laggards outperform. So whereas you wanted to own the market cap weighted S&P 500 through this concentration cycle, you're going to want to own the equally weighted S&P 500 through the diversification cycle. It has outperformed through every one of those cycles. You're going to want to own small cap stocks. Understand that in the last 3 years, people don't realize this, the Russell 2000 has a negative annual return. Everyone thinks it's a rip-roaring bull market. Negative annual return. Whenever we've had subpar returns from small caps, the next 3 years, they're up 99% of the time with an average return of 16.7% per year. And they're trading at 15 times earnings. So I like those. I like dividend stocks. If you believe rates are coming down, you want to own dividends. Dividends they're like bonds. They don't mature. And they also, many of those companies raise their dividends every year. So if I'm a retiree or pre-retiree, not only do I want income, I want a rising stream of income. So if we believe rates are going to fall, I believe they will. We want to own those dividend stocks. And of course, value stocks. Value has underperformed growth through this cycle for a long, long time. You want to own value. If rates are coming down, the dollar's going to weaken. That's good for international and emerging market. And you want to own both of those as well.
All right, lots of choices and options there, Eric. Thanks a lot. Appreciate it.
Happy to be here.
We're just getting started here on Market Domination. Coming up, shares of Lumen Technologies have been on a wild ride this week following its second quarter earnings report. We're going to speak to the company's CEO, Kate Johnson, on the other side. Plus, relief for the housing market. Mortgage rates falling to their lowest level in over a year. So does that indeed mean good news for home buyers? And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned, more Market Domination coming right up. Mortgage rates falling this week to their lowest level in over a year. Yahoo Finance's Danny Romero joins us now with more. We've been waiting for some kind of decline like this. Break it down for us.
It's finally happening. Good news for potential home buyers and even homeowners themselves. The mortgage rates fell to the lowest level in over a year. Freddie Mac reported the average rate on the 30-year fixed mortgage rate dropped to 6.4%. 6.47% from 6.73% last week. The drop in mortgage rates does come as there is expectation that the Fed will cut rates this fall, next month, which has brought long-term bond yields to fall, which is also pushing mortgage rates down. Now, remember, the Fed doesn't set mortgage rates, but its policies do influence the direction of where mortgage rates are going. But this has been an opportunity for potential home buyers to come out of the woodwork if mortgage rates continue to keep falling. We've already seen that the refinancing activity has come up. We've seen a boost last week, about 16% applications to refinance. That's what Mortgage Bankers Association reported now. But we also have seen the housing market kind of turn the other way in favor of the buyer than the seller. We've seen the total number of homes actually increase about 36% in July. That's what Realtor reported. And some industry experts say that the housing market could be normalizing soon.
All right, so given all that, Danny, what did we see at the home builders today?
So home builders, a handful of home builders have reported second quarter earnings over the past few weeks. Now, home builders are expecting that mortgage rates to come down, but that doesn't mean that they're going to take the pedal off the incentive levels that they have been offering. The most popular one has been the mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan. That's not going anywhere. And especially now that inventory is rising on the resale side of things, there's more competition for them, so more of an incentive to keep those incentives on the table, especially for cautious buyers that are really looking to get into the housing market. Bottom line, mortgage rates is a positive thing for the home builders, and we're seeing some of those stocks pop about 2% today on the heels of mortgage rates coming down.
All right, Danny, thank you. Appreciate the update. Moving on, I'm taking a look at today's trending tickers. Zillow shares, they are climbing after being estimates on the top and bottom lines. The company also appointing a new chief executive officer. So lots of moves for Zillow. We got change in the C-suite. Julie, Rich Barton steps down. He's not going to become co-executive chair. Jeremy Waxman steps in, longtime Zillow exec, was the COO. I like this note from Evercore's Mark Mahaney, friend of the show. Mark, title of his note, Shelter from the Storm. That's what Mark goes with. Reiterates outperformed, does take his target to 55. Mahaney says the upcoming interest rate cuts will help unlock pent-up demand, while Zillow continues to show promising potential with its new product cycles and cost discipline.
Yeah, and there also seems to be some comfort level on the part of analysts and investors with this CEO transition. For example, Daniel Kurnos over at Benchmark said that the CEO role is transitioning to somebody who's been in charge of a lot of the operational improvements at the company. So that seemed to be encouraging to investors. By the way, the stock is still down 15% year to date, even with the pop it's seeing today. So the sentiment going into this has been pretty underwhelming. Zillow has been very slowly trying to claw itself back from its iBuying misstep, which, by the way, Rich Barton came back to the company. This is his second stint as CEO. He came to oversee that effort and then ended up abandoning it. Remember when Zillow was buying homes itself and then reselling them, and that did not turn out to be a good business move for the company. And since then, it's been trying to sort of get back on track.
Aren't we talking to a Zillow executive soon?
We're talking,
I heard that.
In fact, to the new CEO tomorrow.
All right, there you
well,
go.
I won't be here, but you'll be here.
I'll be here.
And
You'll be here in spirit.
I will be.
Oh, I'm introing this one too. Look at that.
Yeah,
Two for me. Moving on to Under Armour, sportswear company beating revenue estimates with better than expected North American sales. Under Armour also lifting its profit forecast for fiscal year 2025. Shares, look at that surge, up about 20% in today's trade. So raised its annual forecast, adjusted EPS to as much as 22 cents a share. Street was closer to 20. So investors like that. Returning founder Kevin Plank saying there's not a lot of high fives yet, Julie, but there's definitely a sense of what we've accomplished to date.
Yeah, speaking of people coming back to the company for further stints here, he is still embarking on more cost-cutting initiatives. It sounds like they're not going to cut any more people, but they are going to cut SKUs. He says Under Armour has too many products, and his plan is to cut the number of products available by about 25%. He also says they want to cut down on discounting, that they have done too much of that, and that should help margins. So that's something it looks like investors are also looking forward to. And most of the reaction to this report has been positive. There is still a little bit caution I saw on the part of some analysts that they're still waiting for a little bit more proof
Especially
that this
in such a
turnaround's
competitive
working.
market.
Yeah, absolutely. Speaking of a competitive market, energy beverages, let's talk about Monster Beverage. Those shares are sliding. CEO Rodney Sachs announced slowing growth due to lower consumer spending, coupled with less foot traffic in convenience stores. We also have seen other companies like Celsius say they're taking market share. Rodney Sachs said on the call, "We are a blue-collar brand, and our consumers are more hard-pressed than consumers in other categories." So slowest pace of revenue growth since the second quarter of 2020.
Yeah, analysts at Bloomberg, by the way, just saying U.S. energy drink sales, they are under pressure from a more price-conscious consumer is how they put it. And then also, as you pointed out, it's not just the macro, it's just a tougher competitive environment, too.
How much does a can of Monster cost?
I don't know.
I have no idea.
I'm not anti-Monster. I've just never tried it.
I'm not an energy drink
sugar-free
gal.
Red Bull kind of guy.
Yeah, how much is it? How much does that set you back?
It's not, you got to want it. You got to want it. I really want it.
And you're not a blue-collar Monster customer, I guess. All right, well, another top trending ticker on Yahoo Finance, not just today, but really this week, has been Lumen Technologies. Thanks to the surge in AI demand and a new deal with Microsoft, Lumen has watched its stock soar over 200% in the past year. The communication services provider reported second quarter earnings on Tuesday. Here to discuss those results and these new deals is Kate Johnson, Lumen Technologies CEO. Thanks for being here. Appreciate it.
Thanks for having me.
And for people who, Lumen's been around for a little bit, but you're the CenturyLink is what Lumen used to be. So telecom company, fiber optics, connectivity is what you guys do. So how much of what you will be doing is linked to AI versus sort of more traditional telecom?
Yeah, our pivot to growth is really all about networking. We're a networking company. We run a very significant portion of the world's internet traffic on our backbone. And what you've been hearing about in the market is really a massive expansion of our network and the internet at large to start building the infrastructure for the AI economy.
I know, Kate, you gave that guidance. I know some of the street had questions just about sort of how sustainable you think the pace of that free cash flow guidance was, not just for 2024, but beyond. How do you answer that?
Yeah, so the $5 billion basically got us anointed as the trusted network for AI. It's a composition of deals. It was not one deal. It was
it was diverse.
It's more than 15 companies in that $5 billion, with several more on the horizon that we're working with and pursuing to build custom private networks for. And so it's an injection of cash into the company for sure now, which gives us free cash flow stability, which will in turn enable us to really accelerate our transformation. We're building a digital platform to make it super easy, quick, secure, effortless to consume network services, and nobody else is doing that.
So I guess to sort of build on what Josh was asking, how much runway, what is that free cash flow sustainability going forward as a result of what you're doing?
We're right at the tip of the spear. This is the very, very beginning of what we think is going to be a 3-phase process of building out this AI backbone. The first phase is hyperscalers, technology companies, cloud companies. All of the companies that build AI models and train them are seeing the proliferation of data, and they're seeing that the internet of yesterday does not serve the AI of tomorrow. And so they're saying, hey, we need you to help us connect our data centers. AI requires data, lots of it. Lots of data requires lots of data center growth. Data center growth, we got to connect them. And that's what we're in the process of doing. That's just the first phase. The second phase is really about enterprises when they start using those models, inference. And we're starting to see the early signs of uptick in enterprises needing more networking capacity in order to use those AI models. The third phase is when AI is a little bit more inculcated into our everyday living, is when AI talks to AI, and we think that the data proliferation during that phase goes through the roof. This is about the next couple of decades, and it's building critical infrastructure for decades.
It's interesting, okay, because as we kind of made our way through this earnings season, and you saw not just the hyperscalers report, but then the reaction, you saw this theme. It just seemed like investors, there was this new kind of skepticism.
Yeah.
I think about at least some, right? Like, okay, spend. Where's the return? I'm just curious how you think about that dynamic.
Every single new piece of technology goes through a J-curve. I mean, just because the big companies are well capitalized and have a ton of cash doesn't mean that they have to produce, return on the first dollar spent. There is a J-curve, and these companies, what they're seeing is this need for a different level of infrastructure, higher bandwidth, thicker pipes, faster pipes, and they're committing the capital to build out this critical infrastructure for decades to come. So the volatility of this week associated with the health of the economy, the questions around, are they getting the return right now or not? The companies that I'm working with, that my company, we are dealing with every single day, are looking at this as a 10 and a 20-year plan.
I also want to ask you about your legacy business here, because looking at the news about the deal, knowing that it's associated with AI, I was then looking at the revenue projections for the company, and revenue is not growing. Revenue is still falling and is expected to fall for the next at least year or so. Is that because the legacy business, and what do you do with the legacy business?
For sure. Telco is experiencing secular decline and has been for quite some time. And the reason why there's so much skepticism, in the story here is because we're doing something completely different than what everybody else is doing. Secular decline, you harvest for cash and you pay a dividend. That is not what we're doing. We're harvesting for cash and we're building a digital platform to pivot to growth. And that's the difference between the two.
Gotcha. All this growth and opportunity you see, Kate, does that mean a lot more hiring for you all to meet those to meet that growth, to meet that demand, to meet those construction requirements? Or no, that's third party?
It's a great question. So obviously we have supply chain. We outsource things that aren't germane to our skill sets, but overall, this company's going through a huge transformation, and we're shape-shifting, right? So we're upskilling, reskilling, we're redeploying people away from lower value work towards higher value work, and of course, we're switching out the composition of our skill sets on a fairly regular basis.
And at the legacy business, which you said where you're harvesting the cash to then invest in this growth business, so it sounds like you wouldn't want to divest that business because you are using it for that cash generation. Is that?
Absolutely, but I think about it as customers who are going to be participating in the AI economy, and they're on legacy technologies, and they need to be moved to modern technologies, and that's what we're in the process of doing.
Kate, great to have you on the show today.
Thank you
for taking
so much
the time
for
to chat.
having me.
Appreciate it. Coming up, it's the latest edition of our series, Goodbye or Goodbye. We are taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned. Much more market domination coming right up.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're looking at the Magnificent 7 stocks, of course, after falling under pressure amid AI spend concerns and the broad market sell-off. What's the best way to play it now? I'm here with Summit Global Investment CIO Dave Harden. Thanks for being here. Appreciate it.
Glad to be here. Thank you.
So we're looking at the Magnificent 7. Let's talk about the one that you like first of all, and that is Microsoft. Now, Microsoft obviously has had quite a run already, although it's come down along with the recent market sell-off here. And it's interesting because you pinpoint one of the reasons you like it is the strong earnings performance here, even though the market, reaction to some of these Magnificent 7s was not necessarily so fantastic.
Sure. I think everybody wants them to be off the charts, right? Like what we've seen recently over the last 18 months and 1 year. But the reality is it still performed very well. It still outperformed earnings analyst expectations. So I think it really does show that the operation at Microsoft, the organization as a whole, is doing really, really well right now. And so we can't ignore that just because we have some high, lofty expectations.
And we can't talk about Microsoft without talking about AI and that opportunity, of course. And one of the other reasons that we did not necessarily see a lot of enthusiasm for the earnings is this AI monetization question, right? What is the return right now on this AI investment? How do you think about that question?
And I would say right now there isn't a lot of return, right? I think Microsoft has the biggest potential. How they execute on that and do they get the return they need, that's still yet to be determined. But if you're looking to invest in AI, you cannot ignore the opportunity that Microsoft has, right? And there is huge potential. And if everybody looks at the money that Microsoft is going to make in AI, I think they're underestimating that potential. That's why I like that stock.
Where do you think that biggest potential is, just quickly, within Microsoft?
Sure, it's in their Word and PowerPoint and Excel. This is used throughout business all over the place. And to be able to think if you were in a Microsoft Word document, instead of going to Google to search, you just search right in your document. What if you had, ChatGPT right inside that document? That would make it very powerful, and people would pay $10, $20 a month and switch their subscriptions right back to Microsoft.
Interesting. Okay, and then finally, there's the enterprise and cloud strength, which I guess is AI adjacent, but this is pre-existing anyway.
Yes, correct. On its own, it is strong, it's doing well, and it's continuing to build market share and do really well in that space. So those are 3 reasons why I really think Microsoft is a great buy right now, especially when you see some of the weakness.
Well, we have to talk about risks. We always do in this segment to this potential here. And, I think that there are some questions more recently about how this AI profitability runway is going to look. And perhaps that's a risk for Microsoft.
Sure. I think if you think about the AI for just a second, that is the opportunity, but it's a two-edged sword. It's their biggest risk. If that takes too long, if Google figures it out before they do with their product, or Amazon, et cetera, that's going to hit some real bumpy roads for Microsoft.
Okay, and before we move on to the stock that you don't like as much, do you own Microsoft?
I do.
Okay, so let's get to the one you don't like as much. That is Tesla. This, I have to say, is one of the least loved members of the Magnificent 7 right now, I think safe to say. And their core business is struggling. As we know, there's just not as much demand.
Yes, they have been struggling for a while. This is nothing new. We've had them on the, if you will, avoid list for some time now, over a year. And I think that's really important. We need to see some more opportunity there, and it's a crowded space. Others are doing really, really well. I know they've had some good sales with selling their truck, but I haven't bought it yet. And many of my friends haven't bought it yet. And the market analysis says I'm not the only one.
Yeah, that's more of a niche product, I guess.
Correct.
Well, we were just talking about AI with Microsoft. And of course, Elon Musk has famously said, if you're going to buy this company, you're not going to buy it for the autos. You're going to buy it for the other stuff, including AI. So
Absolutely.
Why aren't you buying it for the AI?
Well, I think they have a longer time frame. Microsoft can monopolize on that a lot sooner than Tesla. I think there's a good opportunity here, but I don't see the returns here for a good 6, maybe even 10 years. So we're looking in the 2030s for AI with Tesla. Now, I don't think very many people want to bet against Tesla. I just think that you don't go with it right now.
Gotcha. And then finally, there's Musk himself, right? And there's still these questions about his pay, even though that now seems to be by the wayside for the moment. But is that still some people say it doesn't matter, but I guess you think it matters.
Well, I think the reality is it's not necessarily his pay that bothers the normal person in the world, I think. I think it's his volatility. What is he going to say, and when is he going to say it? And let's just put it this way. I don't think any of us know what he's going to say and when he's going to say it. That creates risk to the average investor. And so the reality is we'd like him to continue to lead. We love his leadership, but in the sense of volatility, maybe he becomes a little bit more stable. That's hard to do.
Especially when he has a personal megaphone at another one of his ventures that he owns, X. Let's see what could go right for. Maybe he could, maybe magically he will change and he'll stop tweeting. Or we could see a pickup in EV demand.
Yeah.
What do you think is the likelihood of either of those?
Well, probably the last, right? So clearly, it's still a car company. At the end of the day, it has a ton of technology, but they need to sell vehicles. So if we see more sales for those vehicles, that's going to make me much more positive with Tesla.
Okay, and do you have any position in Tesla?
I do not.
Okay. Well, thanks so much for joining us, Dave. Good stuff. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
Crypto executives were attending a video call with top White House officials today discussing concerns with how the current administration treats the industry. Yahoo Finance's David Hollerith and Ben Worskell join us for more. Guys, it is good to see you. David, I'll start with you. What was the point of this meeting, David? What was the goal here?
Well, Josh, the crypto industry has been calling for a reset under the current administration. And I think there's also the element of the presidential campaign at play here. And also the fact that Donald Trump has come out in support of the sector, has really embraced it in the last several, I guess, year, you would say. So this was really industry executives meeting with current administration officials. And also a representative for Vice President Harris.
And Ben, go ahead. Sorry, Dave.
All right, yeah. So but the point was really for them to air out their grievances under the current administration, the industry, and certain regulators, the SEC, most prominently, have been at odds in some disputes. And it was about airing out those concerns and then also moving forward into ways that the industry could feel more supported, if that makes sense.
Well, and Ben, what's interesting here, too, is there is so much speculation about the presidential campaign and their relationships, the candidates' relationships with the crypto industry. But this seems like didn't have anything to do with the Harris campaign.
Yeah, I mean, the way I would look at it is kind of a first step. This is kind of a multi-pronged, call it a charm offensive, call it whatever you want, between crypto and the Democrats. Well, we had this meeting this week. We also have a meeting coming up next week, which is a larger crypto for Harris. We've seen all these big Zoom meetings since Harris got in the race. Black women for Harris, white dudes for Harris, and now next week we'll have crypto for Harris. So I think this will continue to evolve, and this was a kind of, as Dave said, was a kind of first step in airing of grievances with the White House side that we'll see continue in the weeks ahead.
David, I'm curious, did SEC Chair Gensler come up on the call at all? Do we know?
He did. We know, at least from a source familiar with the matter, that at least one person on the call brought that up. And generally, how the federal securities regulator has sort of been working with the sector, or aggressively been cracking down on it by the industry's perspective, largely was brought up and addressed. And so was the banking regulators positioning on crypto for banks. Crypto banking partnerships are obviously highly scrutinized at this point.
All right, Ben and David, thank you both. Really appreciate it, and looking forward to continuing coverage of this issue. Well, coming up, shares of Eli Lilly surging on stronger than expected sales of its weight loss drug. We're taking a look at the best ways to play the trend, and next on Market Domination. It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers,
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
McKesson Corporation shares are sliding. The prescription drug distributors' revenue forecast for the year falling short of analyst expectations. And in particular here also, even last quarter, if you look at a couple of its different areas, medical surgical solutions, the revenue there up 1%, but it fell short of estimates. And prescription technology solutions revenue down 0.2% and missing estimates. And that, it seems like that's kind of, Josh, what analysts were highlighting, those couple of areas where there was some more weakness.
Yeah, I think people made a beeline really for that revenue in the company's prescription technology solutions segment, because that includes the GLP-1 drug patient services, and that did come in light, 1.24 billion. That misses. The street wanted to see something closer to 1.46 billion, so some disappointment there. And this was another name, by the way, that obviously investors have piled into as well.
Yeah, I mean, and the company also announced a buyback, by the way, $4 billion buyback authorization, but that didn't help. To your point, the share's up about 17% this year, even with that pullback that we saw today.
All right, well, tale of two weight loss drugs in the second quarter. Sales of Eli Lilly's blockbuster drug Zepbound came in higher than expected, prompting the company to raise its full-year sales guidance, while Novo Nordisk slashing its profit outlook after Wegovy sales fell short of expectations. We're going to take a look at how to best play the surging demand in GLP-1s in our Yahoo Finance playbook, with more on how to play the GLP-1 hype. Moritz Pot, Tima, ETF's founder and CEO, joins us now. Moritz, good to see you.
Good to see you. Thanks for having me on the show today.
So we were talking off camera, Moritz, about how a lot of times I think people, they think about GLP-1s, the trend, and investors excited about it. They often frame it as like there's just these two giants. There's Lilly and there's Novo, right? Moritz, you say it's not that simple. There's others. We should broaden the horizon a bit.
That's a great question. So the industry today is defined by two horses. The little horses you mentioned, Lilly, Novo. But we think actually over time, this is going to be a 4 to 6 horse race. Because right now, you only have one device, which is injectable, going after one treatment, which is weight loss. But in reality, we're seeing innovation in parts of the market. We're looking at people looking at oral instead of injectable. People are looking at applications beyond weight loss. Could it be used in Alzheimer's? Could it be used in sleep anemia? Could it be used in oncological disorders, in heart disease? And then also you're looking at how can you make the patient experience better to reduce side effects, to reduce frequency of dosage, to ultimately increase the continuation rate after 12 months. A challenge today is one, the affordability, but two, also the accessibility. There's a big drop-off after 6 to 12 months. How do you ensure that people stay on the drugs for longer?
And so how do you do that? And then how do you invest in that idea?
Yeah, so Rati, these are big CapEx cycles with big R&D budgets. I mean, Eli Lilly today mentioned that it took them 8 years for tirzepatide to basically get approved to where it is today. They first got their stage 1 approval in 2016. That kind of gives you an idea. This is an 8-year journey. So we think, again, that there is a number of competitors, but you need big balance sheets. You need to obviously have like the ability to actually run the trials and to actually like develop and iterate on the trials. And this is not going to be straightforward. So we've seen Eli Lilly now moving with their Chugai oral drug into phase 2. Eli Lilly is also progressing another oral drug outside of what they're doing with Chugai. We're seeing Viking moving an oral drug into phase 3 last month. So there's a number of players that are in the space. You've seen also the readout from Roche last month on their Carmot asset, which they bought last year in Q4. So there's a number of people in the space. In reality, there's only 2 drugs approved today in the US. We think it's not going to be a question of this year, maybe of next year before we see more drugs approved, but we do see more innovation beyond just weight loss and beyond just injectables.
And 2 other names in your product, your ETF. So, I mean, obviously besides Lilly Novo, you've got Alnylam and Amgen.
Yeah.
Why are those 2 in there?
So we think Amgen is very interesting, working on a lower frequency of dosage approach. And Alnylam is taking a more genetics approach, which again is unproven, but the early data is pretty promising. And looking at the way you could use genetics to actually treat or to address the underlying obesity issue is a challenge that not many people are focused on. But obviously, if there's clear data there, that'd be very promising. So we really try and invest in both the established leaders of today, which is Lilly and Novo, but also thinking out who could be the 3rd, 4th, 6th horse in this race, given that we strongly believe this is not going to be a 2-horse race over time.
I'm also interested to see in the ETF 2 names that have been hurt by all of this. I'm talking about Dexcom and Insulet, which are more diabetes providers here, because the thinking was if fewer people are suffering from diabetes because they're taking these drugs, they won't need those products. So how do they fit in?
So the reality is the direct inference is that, well, that if people, there's less obese people, then there would be less demand for these medical devices. But the reality, the medical devices also treat other ailments. And there's also second order effects from basically taking weight loss drugs. For example, one being muscle loss. So we think that actually, while the contrarian view is to own Dexcom and Edwards, especially after the drop of the past month, we actually think they're quite attractively priced. Because the concern with some of the GLP-1 players is the valuations. And that's not a concern we see. So we think actually the runway for Dexcom and Edwards will change with GLP-1, but it's actually still very interesting, especially these valuations.
I'm curious, Moritz, when you and your team think about just the GLP-1 market broadly, how big is that market?
So today, the biggest estimates from Goldman are about $130 billion a year by 2030. We think this could be $500 billion market. Why?
How do you get there, Moritz?
So we get there in 3 ways. One, today we see 1 billion obese people in the world today, based on the latest data from Imperial. That's estimated to go to 2 billion people by 2030. 2, people think about weight loss drugs today just in the context of weight loss. But if you think about GLP-1 as a drug that could also address other disorders, whether it's neurological disorders, oncological disorders, or even cardiovascular disorders like heart disease, then actually you see a much bigger TAM. So simplistically, if we just think about, let's say there's just 1 billion people, let's say that 20% of people by 2030 are on a drug. Today that's 2%, so that's 10x the penetration from today. And let's say that pricing drops by 60%, below $5,000 a year. Based on those numbers alone, we get to about a $500 billion plus market. So we think this is a market which is only going to grow. So far, estimates basically are doubled every 3 to 6 months. And we may be early, but we think this is a $500 billion opportunity by 2030, unless we see something change in 1, regulation, 2, something in prevalence, or 3, we see that there's a better drug that looks beyond GLP-1, which we don't see today.
There was a really interesting report out from Charles River Labs, which is a drug development company, which basically said sales are not going to expand this year. It's seeing a big drop in drug development interest from pharma companies. One of the reasons it blames was the Inflation Reduction Act and sort of Medicare negotiations. Yeah. How is that going to affect, if at all, the GLP-1 universe?
So price is definitely coming down. Price is already coming down. Novo yesterday said as volumes go up, price will come down. And obviously as reinsurance reimbursement increases, actually the net back to manufacturers will further decrease. But given the scale of the challenge, where we have 1 billion obese people in the world today, Novo Nordisk yesterday estimated that only 2% are being treated. That shows you just how big the market TAM is in terms of volume. So even if
it's a volume game, not a price game.
It's a volume game, not a price game. And ultimately, understandably, the government wants to make these drugs more affordable and also more accessible, which means that pricing has to come down. So we think that pricing will come down. Pricing may come down more than we expect, depending on whether you're looking at insurance covered or non-insurance covered space. But we think that's ultimately, it's a good thing for patients. We think that the demand is so big and frankly is outstripped by supply that we don't see that as a challenge. And thirdly, frankly, that will also allow more people to get access to the drug earlier. The challenge today is supply. If you look at the Novo results yesterday, they weren't bad results, but what they really underscored is that Novo is just struggling to keep up with the demand they're getting for their drugs. And Novo is very focused on making sure that people who start on a sequence of GLP-1 on Wegovy can actually finish it. And the challenge today is that, frankly, if you could start on it but you can't get supply to continue on it, then frankly, what is the point of starting in the first place?
Moritz, you mentioned regulation, you mentioned government. We have an election coming here, right? Are you all on your team trying to game out potential impacts, Trump versus Harris administrations on this market?
So I think both sides of the political spectrum believe that affordability should increase, availability should increase. So both sides of the party will advocate for lower pricing. At the same time, I think both sides of the political spectrum also believe that this is a major issue, which obviously affects patient lives, but also has societal implications, societal costs. So our view is that there's going to be a general consensus around how do we improve the access, availability, affordability of these drugs. The question is how much of it will be covered under Medicare. And obviously, Wegovy is, Zepbound is starting to be, but there's still obviously a question on general insurance coverage. So we think that the political will to expand access will increase. The political will to basically drive innovation or to support innovation will increase. The question is, what will be the insurance coverage, and to what extent will that come from Medicare? So we don't really see the upcoming election as a challenge. We actually think this is one of the few areas where both parties are pretty united, not on general drug policy, but specifically on GLP-1 drug policy.
One of the few areas you actually see right and left coming together, maybe.
Correct.
We'll see. Moritz, thank you so much for joining us. That was great.
Thanks for having me.
Moving on here, Delta is now detailing the financial impact of the CrowdStrike outage. The airline in a filing saying it expects a $380 million revenue hit in the current quarter from the incident that grounded flights for days. It estimates the total impact will cost it some $550 million. Delta also reiterating it is pursuing legal claims against CrowdStrike for that incident, Julie.
Yeah, we've been waiting for sort of the filing to get more details on this, but this has been reported on that this was going to be an issue for the company here. The stock has come down quite a lot since the outage happened, but even before that, we had seen Delta sort of peak and start to come down. It looks like its high was back in mid-May. And there are some broader questions about travel demand right now, and then pile this on top of it. I mean, I think also why it has been so surprising to investors is most of the folks we talk to who cover the airlines see Delta as best in class.
Yeah.
When Southwest experienced its troubles, it was sort of didn't necessarily tarnish an image of a perfect airline. In Delta, it seems like
well, yeah, because it was
kind of happening.
The outage, it did hit various sectors and verticals, and including the airlines, and Delta did seem to really take it on the chin a little harder.
More
right?
so than its competitors as well. All right, we are counting down to the closing bell on Wall Street as stocks are soaring. The S&P 500 on track for its best day since January 2023. The Dow is up more than 600 points, about 650 points right now, and it is a broad-based rally. All sectors participating.
All right, while we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings from Paramount. Stay tuned for market domination overtime.
That's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended the day near the highs here. The Dow up by 683 points when all was said and done, 1.76% higher. The S&P 500 with its best performance going back to January of 2023 with this 2.3% gain, and the Nasdaq up 2.9%. Did you guys go back to the S&P for a minute? When we look at the past week here, we're kind of, lower than where we were, but we made a little bit of a round trip, so we'll see if that keeps going. It was quite a broad-based rally today. As we pointed out earlier, the Russell 2000 keeping pace with the S&P 500 and its gains. And then also, if you look at the components of either the Dow or the Nasdaq 100, you see not a lot of red. One stock very slightly in the red in the Dow, and that's United Healthcare. And then if you look at the Nasdaq 100 here and equal weight that one, you got what, maybe half a dozen or so stocks in the red in that whole index. So again, just showing that it was quite a broad-based bounce back today, Jared.
Well, I'll take it from here. We got our leaders index. You don't see any red on this board right here. And in fact, Bitcoin was the #1 gainer of the day. And even bonds were doing some work on the low end, high yield up about 0.4%. But chip stocks really clawing back some of those steep losses. We got ARC components, momentum, IPO. So as Julie said, just broad-based risk right here. And let's check in on some of the unprofitable names that comprise the ARC Innovation Fund. That's disruptive tech. And you see a lot of green here. Shopify up 7. So is Coinbase after a nice drubbing it took in the previous days. Roku up 5%. But I just want to show you real quick what the 5-day looks like with some of these. Only Staples in the green. Only Staples has managed to stay above water over the last 5 days. Consumer discretionary is the worst off. And then taking a look at leaders, small oil and Bitcoin actually the worst off over these 5 days. Josh?
Jared, thank you, buddy. Roller coaster ride on Wall Street, climbing higher today. The S&P 500 having its best day in over a year. And joining us now is Larry Adam, Raymond James Chief Investment Officer. Larry, it's great to see you. So I got green all over my screen, Larry. We did get some new economic data this morning, new data point on the labor market. And it seems like that's given investors some relief and some confidence about the labor market, maybe about the overall economy. What do you make of it, Larry?
So I think what happened over last Friday and then Monday, I think everybody got a little bit premature thinking that this economy was going to roll over into a recession, that the Fed was going to have these emergency cuts. And the reality is that the economy is slowing, but it's not collapsing. And I think that that's what you're seeing with all the statistics that are coming out right now. We actually believe that this economy is going to slow the quarter that we're in, and next quarter, we think GDP growth is going to be around 1% or lower, but we don't think we're going to see any form of a recession.
And so what are the implications of that for the markets, Larry? And at what point, we had obviously a dip, now we're coming back. What is pricing in that type of a slowdown and cuts by the Fed in September? What does that look like? Has it already happened?
Well, it's a great question because we've been using our target of 5,400 as our guiding light. So when we've gotten above 5,400, when we got closer to 5,700 back in July, that's when we got a little bit more cautious on the market. And obviously now that we've fallen below 5,400, you can become a little bit more optimistic. I think we've learned over time, right, that the market loves these narratives and you get to see these more extreme moves. We tend to rely more on the fundamentals, what we think earnings are going to be, and then a reasonable valuation to see what our target should ultimately end up being.
I'm curious, Larry, as we make our way through the month of August here, what other catalysts, potential catalysts, would be on your radar? Is it CPI, Jackson Hole? What would you be looking for, Larry? Is it NVIDIA earnings later this month?
I think it's everything that you just said, right? Especially in the month of August when you get a little bit more of the doldrums. I think it'll be important for the Fed to convey and telegraph that they are going to start their easing cycle come September. So I think that will be important. Part of the catalyst of that happening will be hopefully next week that we will see inflationary pressures continuing to move lower. And I think that that is likely to be the case because from all of the signals that we see, you are seeing prices, broadly speaking, continuing to decelerate. And then you're right. I think there's been a lot of questions around this theme of AI. So obviously, NVIDIA's report will be very important to see the sustainability of that theme. Our base case is that the AI theme is still very early stages and that it will continue to drive the tech sector for the foreseeable future.
So during this recent sell-off, were you guys adding to AI-related names, or is it just a matter of you don't think people should be selling them?
It depends on your exposure to the tech sector. I will give you a quick tidbit here that yesterday, for example, that the mega cap tech stocks in aggregate actually went into oversold conditions. And if you look back over the last 10 years, that's occurred 9 times. 8 out of 9 times, 12 months later, they've been up and they've been up on average about 35%, outperforming the S&P 500 by almost 20%. So that dip buying when it comes to these tech stocks that have pretty good visibility in their earnings moving forward, I think ended up being a good opportunity to get into that space.
Got to ask you about the election, Larry, politics. Trump speaking today at a press conference. What kind of questions are top of mind for your clients about that? And what's your advice?
So I think there's two big questions. Number one, should I change my allocation or my sector positioning? And I would say no. I think we've learned from the past that politics is something that we look at on the fringes. It can be an impact on our sectors. But when we look at our bigger foundation of how we come up with our views, it actually ranks number 8 out of the 10 factors that we look at. So it's not as important as how the economy is doing, earnings, the Fed, those types of things. The second thing that I'd point out is that I do think some of this volatility recently has been because of the election. And it's not ultimately on who is going to win or lose, but it's the fact that we've seen increased uncertainty. Because you have to remember now, this is an open election where you technically have 2 non-incumbents running. And if you do look back historically, and we go back to 1945, we've had it 7 times where we've had an open election. From this day to election day, the market on average has been down around 3% because of that uncertainty. The good news is that once you do ultimately get the results, the market does tend to bounce back.
Yeah, and interesting, of course, it's not just open on the presidential level, but also the congressional level as well. Larry, I'm wondering how you are thinking about fixed income right now, as well as we've seen this turmoil in stocks, but a lot of people have been in short-term bills, right, or in cash. How are you thinking about maybe to reallocate some of that?
So we've liked the fixed income space. We've been talking to clients about slowly. Again, you still get around that 5% in cash-like investments, so it's still a pretty robust performance, but slowly starting to lengthen duration, because I do think when the Fed starts to cut, you're going to start to see those shorter-term rates come down quite dramatically, and I think you want to lock in these higher, longer-term rates for longer. So we're starting to extend our duration with our bond exposure.
Larry, good to see you. Thanks for joining us.
It's always a pleasure. Thank you.
Thanks. Coming up, a new survey shows that CEO confidence is pulling back in the third quarter. And we'll take a closer look next. More market domination overtime on the other side. A new survey showing a decline in CEO confidence for the third quarter. That's according to the Conference Board and the Business Council. CEOs citing cyber risks and geopolitical instability as their top concerns in that survey. While CEOs do remain moderately optimistic about the economy, others like JP Morgan Chase CEO Jamie Dimon say that the odds of a recession coming are more likely than not. For more, we're bringing in Steve Odland, CEO and president of the Conference Board. Steve, thanks for being here. Really appreciate it. Help us understand these numbers in context, right? Because yes, there was a pullback to 52 in the reading, down from 54, but 50 is sort of the dividing line between, people feeling better and people not feeling great. So how should we think about these numbers?
Yeah, that's exactly right. There are 130 CEOs that were surveyed here with this Conference Board Business Council survey that we do every single quarter. And we see that range going from 0, which would be really bad, to 100, which would be perfect. It's never at the extremes, but we're sitting at 52 here, which is roughly in neutral. So CEOs are looking at their current conditions, and they're kind of negative about where we are. The economy is slowing down. Their businesses are a little bit tough right now. But when you start to look out the next 6 months, they are more optimistic. So they think that once the Fed begins to lower the discount rate and that works its way through the economy, debt costs go down, that the consumers will have more money, and that the economy will pick back up. And so that's why they're more optimistic about the next 6 months versus their current conditions.
Steve, I'm curious, as you looked through the survey and you saw the results, was there anything surprising to you, Steve?
Well, these CEOs, these same CEOs 1 year ago called for a recession. Over 80% of them said there would definitely be a recession. Now, that's because in history, as the Fed has gone through these cycles, it's very tough to bring the interest rates up, obviously inflation down, and to land the economy. They didn't think it was possible. What you see now is that very few of them are saying that there actually will be a recession. So this is what a soft landing looks like. It's a situation where we've got wages still rising, we've got interest rates ready to come down, we've got inflation rates moderating, we've got employment still positive, and the markets have held up very well. I know there's volatility, but we're still within a few points of an all-time high. This is a soft landing, and it's not very often that you get to see this.
Steve, I'm curious what the survey period was here for this. Was it before we got last Friday's jobs report? Because I do wonder, maybe if it was before that, you can tell us if you've had any conversations with folks since then that has changed their view at all.
Right. Well, this poll was done in July, before last Friday's jobs report and the market volatility. However, these folks know what their job situation is. So, essentially, they have it baked into these numbers. And what these CEOs are doing is they're job banking. In the past recessions, and when we've gone through these cycles, there's been huge layoffs. They're not doing that. And it's because we've just come out of this period through COVID where they've had skills shortages and job shortages. They haven't been able to get the people. And so they're job banking. They're holding on to their talent, which is actually good for the economy because that means that people are still working and they're still earning money. And that comes back into the economy. So this is all deliberate on their part, given the situation in the job market.
Steve, given the election, we don't know who's going to be in the White House. We don't know what that means for the regulatory backdrop, just the broader regulatory environment. How do you think, or do we have any line of sight to how CEOs are thinking about that?
Yeah, in some ways, these two people are not an incumbent, but in some ways, they both are incumbents in the sense that, on one hand, you've got a continuation of the last 4 years. On the other hand, you have a continuation of the previous 4 years. So I think it's pretty easy for companies to predict and, listen to what the candidates say their policies will be. And that is influencing what CEOs are doing at this point. And that's part of the reason that they're in neutral, because they're very different people with very different policy ideas here. And so the environment could be very different post-November. And so I think people are just sort of waiting to figure out where things are going before they make commitments to invest in plant, capital equipment, and more people.
Steve, I thought it was interesting as I look among the concerns that folks listed as being high. Cyber is number one by a pretty wide margin, geopolitical instability, legal and regulatory uncertainty, AI and new technology, and then I get to financial and economic risks at 39%. And I'm curious that that is so far down. Sort of anecdotally, what we've been hearing from companies this earnings season, a decent number of them, is that they're concerned about consumer demand, particularly at the low end. So I'm just curious if that's reflected elsewhere in the survey.
No, I think that's right. I think, people are very concerned. CEOs are very concerned that their businesses are slowing, that the consumer's running out of money. But they all predict that there's going to be at least 1 or 2 rate cuts here before the end of the year. When that happens, that should release more money into the markets. You just saw mortgage rates come down. Most recently, they're at a 15 or an 18-month low. That's helping refinancing. So they're positive about the financial situation, but that's going to be impactful into 2025, and that's what's going to be required to pick the growth rate up here.
Steve, these 130 CEOs who participated in the survey, can you give us a broad sense of what industries, what sectors and verticals, Steve, do they represent?
Think of the Fortune 150 companies. These are the largest companies. These are the who's who of CEOs who are responding to this survey. They run multinational companies that in some cases are bigger than countries. So this is very representative across industries, across the economy on what's going on. And historically, the CEO's point of view has been the most informed and has been a bit of a leading indicator, not perfectly, but they see what's coming because they're looking at their own business, they're looking at demand, they're looking what's happening with their workforce. So, the fact that they're sitting here saying that the next 6 months look better, that the Fed should start adjusting, that after that consumer demand should pick up, that feels pretty good. And the fact that we're sitting here in a little bit positive situation when we could be in a bad recession, and that's what they predicted a year ago, that's almost a miracle. So this is about as good as it gets in this cycle.
Steve, thanks for joining us to give us some perspective on that survey. Appreciate it.
Glad to be here.
Paramount out with its second quarter results. The shares right now up 5.5%. We've got Yahoo Finance's Alexander Canal here to give us the details on the numbers. Ali, what are they?
So I think the reason why the stock is, I wouldn't say rallying, but up 5% at this point is because we have our first quarter of streaming profitability. In the second quarter, Paramount reported operating income for its direct-to-consumer streaming segment of $26 million. That was a $450 million improvement from the prior year period, and the company did report a loss for the segment of $286 million in the first quarter. So this was pretty significant there as the company continues to aggressively cut costs ahead of that proposed merger with Skydance, which is expected to be completed in the third quarter of 2025. But other than that, it wasn't too great of a report. We had
I'm looking at these numbers.
Yes, the revenue missed expectations. We also have linear ad revenue falling once again by double digits, down 11% year over year. That's worse than the 10% analysts had expected. And similar to what we saw from Warner Brothers Discovery, we have a nearly $6 billion goodwill impairment charge related to, you guessed it, the cable networks. And that's exactly what we saw with Warner Brothers Discovery. Now, WBD was more aggressive, a $9.1 billion impairment charge. But I think this is interesting. And I was going back and forth with our head of news, Miles Udlin, about this, about why now? Why is this all coming to a head now? And perhaps we're entering a cycle where these companies in particular, they want to do some sort of deal. They want to do a spin-off of some kind. Maybe now is the right time to start cleaning up your balance sheet, and impairment charges, they do make the financing demands for a takeover lower. So that's something I want to dig a little bit deeper into over the next few days, is why this is all happening now. And I mean, clearly there's this transition that we're seeing across the media landscape from linear to streaming, but it's a bumpy road to get there.
And you mentioned Skydance. So Paramount, of course, agreed that Skydance deal last month. What is the Skydance plan for this asset?
Cut costs, cut costs, cut costs. That is what they're planning to do at this point. Last month, we did hear from the new leadership team on their strategic vision. It's going to include $2 billion in cost cuts that will be delivered, quote, pretty rapidly. And basically, they're saying that they love the creative engine of this company. They love the IP. That's one of the reasons why David Ellison was attracted to Paramount, is really the content. But they did call out that there are certain areas of the business that are in decline. One of them being linear cable. So I would think that that's an area they want to just get rid of.
And one thing, you might have mentioned this already, forgive me, Warner Brothers Discovery, one of the bright spots was it did announce, I think subscribers grew, correct?
Right.
Paramount Plus subscribers went down by 2.8 million to 68 million. It sounds like part of that had to do with the exit from South Korea. They had a bundle agreement there, but even still, it's not the right direction.
Right, that is really what they blamed it on. It sort of seemed like the wording in the release was that this is a one-off. I'm curious on their earnings call if they're going to elaborate a little bit more on that. But we're in this era too where all these companies are raising prices. The consumer is getting a lot more choosier, and you wonder if that had any impact on churn.
You're also just wondering, I mean, Paramount Plus, like you think about their originals.
Yeah.
Like, what's the Paramount Plus original that you
Isn't what's the cowboy one or the
Yellowstone?
Yeah. Isn't that on Paramount Plus?
Yes, that is really their pride and joy. That's like what Game of Thrones is to Warner Brothers.
Yeah, but is there anything else? Is that the main one?
They keep doing spin-offs and related series, but yes, I think
it's part of my point. Like, I just can't think of any.
Yeah,
this is my issue, and that gets to like the cost cutting. Is like, if I can't think of any, that to me says you're gonna have to spend a lot. I mean, ultimately, it's subscribers, it's watch time, and to create great content requires a lot of money.
Yeah. Requires a lot of money, and this is something that the Skydance team is going to have to figure out. I mean, like we said, it's going to close in 2025 by the third quarter, but until then, I think we're going to see a lot of fireworks, a lot of activity on what you do with some of these other more depressed areas of the business.
I love that Josh has Paramount Plus up on his computer because
I was
trying to figure out what the heck
this is what I'm doing.
I think I know, because I agree.
Producers keep telling me things in my ear, but I can't hear.
It's very hard to know what to watch these days. You're inundated with so much content, so we'll see.
It's true. Thanks, Sally. Appreciate it. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The markets have moved on from Monday's panic with another day of green across the board. The Nasdaq Composite having its best day since February, and the S&P 500 seeing its largest daily gain since November 2022. Better than expected jobless claims helping allay concerns about the labor market. Plus, once upon a time, revenge travel was a boon for hotel and resort names, but names across the sector, including Disney, Expedia, warning the inflation-weary consumer is pulling back. We're going to take a closer look at what softer demand means for the industry. And after Monday's sell-off and a capex-heavy earnings season, some say the AI trade is losing its luster, but not for all. Voice AI company SoundHound reporting record revenue second quarter with a top and bottom line beat. We're going to speak with the CEO within the hour. Consumer weakness is showing up as travel-related companies report earnings. Expedia warning of a softening in recent travel demand in its latest results, and Disney flagging a moderation in theme park demand that it expects could weigh on income for the next few quarters. Joining me now is Jody Lurie, Bloomberg Intelligence Senior Credit Analyst. Jody, it is good to see you. And I'm interested, Jody, just kind of start at a higher level and get your take on the American consumer. And I think as we make our way through this earnings season, Jody, we're all trying to look for clues about that. It can be kind of confusing, even in today's trade, Jody. I mean, I'm looking here, Under Armour ripped higher. On the other hand, I got Monster Beverage in the red, Topgolf Callaway is in the red. As you look through these earnings reports, you listen to the conference calls, what is your takeaway, Jody? How does the consumer look to you?
So, Josh, I think we're starting to finally see the shift in the consumer. And by that I mean is that when we started off this year, we anticipated that there would be moderation in the consumer. That was actually the title of our outlook. And we were surprised when we ran our survey of travel that the consumer was actually very much planning on spending on travel. Even if they were pulling back on goods, they were still spending on travel. They're still spending on leisure. They wanted to go and do, but they were showing signs of selectivity. By this, we mean that they did respond that they would pull back on restaurant spending if by chance they exceeded their budget. So I think that really at the end of the day, we're now starting to see that slowly take shape, and we're seeing it mostly at the lower end consumer, and we're also seeing it out of China.
It's interesting because we've heard a lot about the low-end consumer. But are you seeing any signs that that's kind of, and you can look through some earnings reports and see signs that it's kind of creeping up the income ladder a bit though as well, Jody?
It is creeping up to some extent, but if you look at, for instance, Hyatt, right? So we cover the hotels, we cover the restaurants, we cover the gaming companies, we cover the cruise lines, the theme parks, and the rental car companies. And so it's a really broad mix across the consumer spectrum. We really get the low-end consumer, the high-end consumer, and the business traveler. And for someone like Hyatt, you are seeing some softness, but maybe not as much. Their softness is coming out of China. But for someone like Hilton that has much more of the middle market, you are seeing signs that they're not as optimistic, at least heading into the end of this year, when it comes to what they call transient leisure travel. They are still optimistic when it comes to business and conferences. And I think that's going to be the tailwind that kind of pushes a lot of these companies through. But when it comes to the traditional leisure travel consumer, we might not necessarily see as much robustness as we saw in 2023 or 2022. The exception is in cruise lines, where the bookings are done way in advance, where consumers are booking for a cruise next year and booking rates are at record levels.
Are there certain, because I know you know that sector so well, Jody, are there certain cruise lines that you think are better positioned than others right now, in terms of just the backdrop, the macro?
Sure, Josh. So, I think that there's a couple of components there. So we've been very adamantly pounding on the table that the cruise line story is one of credit quality. It's not one for the equity markets. It is a bond story, right? And we're finally starting to see that the equity markets are quote unquote benefiting because Royal Caribbean just reintroduced their dividend. Now, we've been saying for quite some time that Royal Caribbean is a few quarters ahead of Carnival when it comes to repaying their debt load, bringing back the balance sheet towards quote unquote normal normal and getting the company back on track. They were first to start cruising again, and they've slowly kind of been repaying their debt at a much quicker rate than some of their peers. Now, someone like Norwegian has been taking the attitude of growing EBITDA to improve leverage as opposed to repaying debt. And that could be something that could be problematic should the consumer pull back and should that start trickling into cruise lines. Where Norwegian does benefit is they market more heavily to the high-end consumer. So maybe they feel like they're more recession-proof, or they won't necessarily feel this as much. Plus, most of their consumers come from the US, which is concentration, but they don't get the Europe effect. They don't get the China effect the same way that you might see at a Carnival.
They're telling me I have to go, Jody, but I'll sneak one last one in. You think there's too many cruise lines at this point?
Too many cruise lines. It depends who you ask, Josh. If you are talking to Venice, Italy, they might say yes. They've definitely stopped that. Certain European cities are talking about pulling back on cruise lines, allowing to dock. That's still developing. The water is a very large place. It's really a question of supply and demand at this point. I can't say whether or not there's too many cruise lines. Are there too many cruise ships? Who knows? I guess time will tell.
Jody, great to have you on the show today. Thanks for joining us.
Sure thing. Have a good one.
U.S. stocks jumping after initial jobless claims data eases concerns over the U.S. economy. Yahoo Finance's Josh Schaefer joins us now with more on the trading day takeaways. Josh.
Hey, Josh, I want to start with that economic story because remember, recession fears have been creeping into the market over the last couple of days, and that was part of what brought stocks lower after that July jobs report. Well, today we had our first look at the labor market since that jobs report, and we had weekly initial jobless claims. This is the amount of people filing for unemployment on a weekly basis.
Initial claims, moving markets.
Moving markets. This comes out every Thursday, and most Thursdays it comes out, and no one talks about it. But today at 8:30, it was a big deal when this number came down from its 9-month high. 233,000 claims were filed, below the 240 that was expected. But to your point, Josh, the biggest takeaway here that was just kind of shocking, you had Nasdaq futures, Nasdaq 100 futures basically flat at 8:30, right up to 1% on the day, and we never really looked back. So clearly this was in focus. Investors just wanted to feel a little bit more comfortable, I think, with the economic narrative. Now, I think zooming out and sort of what do economists say about this number and the data, we're going to need to see more. 1 week, it's a very volatile data set. It's often revised, so maybe it didn't flash concern. I think it actually might have been a bigger deal.
Were any strategists saying, were any strategists you're reading kind of voicing, surprised that we would move that hard up initial claims?
You're feeding me to takeaway two, which is more signs of an uneasy market. Neil Dutta over at Renaissance Macro, who's been calling for the Fed to cut.
Very smart guy.
He's been calling for the Fed to cut, and he sort of said, NASDAQ up 1.2% at 935 off claims, really? That shows me that maybe the market is reading a little bit too much into data right now. And when we just look at the action over the last couple of days, it's not hard to see, right? So we got a 10-day up here at the S&P. Look at what we've been doing this week. Up, down, up, down. Today you had the biggest jump in the S&P 500, up 2.3%. That's the biggest jump going back to November 2022. So think about all the gains that we've seen over the last 2 years now. That's a big gain, 28%.
Yeah.
But this was the best single day move. So that just gives you a feel for how much back and forth jump we've been having. And Neil Dutta pointed out with that, think about what we have coming up next week. Next week you have a big CPI release. You have retail sales, sort of saying that the big up and downs we've been seeing in the market, maybe that's not over, and that's going to be a theme that we're watching kind of through the rest of August at this point.
Yep, sounds good. All right, Schaefer, bullet point number 3.
We do not have bullet point number 3 today, Josh. That's all I got. That's all I got for you today.
I shouldn't get greedy. That's it. Thank you, Joshua. Coming up, shares of SoundHound are rising following its latest earnings report. I'm speaking with the company's CEO on the other side. Stay tuned. More asking for a trend still to come.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
SoundHound AI posting a revenue beat for the second quarter, reporting an increase of 54% year over year. Results coming on the back of the company's Amelia acquisition announcement. SoundHound looking to capture AI opportunities as enterprise spending on generative AI gathers momentum. And joining us now to talk about all this is SoundHound AI co-founder, CEO Keyvan Mohajer. Keyvan, it is good to see you. So you just reported revenue for the second quarter, Keyvan. That's a beat. Jumping more than 50%, 13.5 million. The street was close to 13.1 million. The stock is popping here in the after hours. Walk us through the quarter, Keyvan. What drove the business?
Well, thank you for having me back. It's great to be here. We had a record Q2. Our revenue grew 54%. We had guided 50, so we're very proud of that. We signed up new customers. We expanded with existing ones. We signed up 2 new quick service restaurants. We are now working with 5 of the top 15. We signed up one of the largest pizza chains. And in automotive, we were the first to go live in production with generative AI, and that has worked well. We've expanded that. We are now in over 20 markets, support dozens of languages, increasing our royalties, and we have improved our financial strength. We paid off our debt last quarter, and we finished the quarter with over $200 million of cash.
Let me ask you also, Keyvan, the acquisition you announced here of Amelia. Talk to me about that acquisition, how that deal came about, Keyvan, and what's going to mean for your business.
Yeah, we bought an amazing company. We announced it this morning. It's called Amelia. They specialize in conversational AI for customer service. So do we. And they're in different verticals that we wanted to go after. That's a big part of our business. It's a big part of our growth. There was a McKinsey research that showed enterprise spending on generative AI is going to reach $250 billion within 3 years, and AI customer service is a big part of it. With Amelia, we are now able to go into verticals that we wanted to go to, and that path is now accelerated. Now we were in restaurants, we were supporting smaller businesses, but now we are in healthcare, we are in financial services, insurance, hospitality, and retail.
So those are, healthcare, financial services, Kayvon. Those are obviously, more regulated industries, more regulated verticals. Was part of the thinking there, it was just going to be easier for you all to move in with an acquisition? Amelia already had a footprint rather than trying to do it standalone?
Yeah, so we have the amazing technology to power those experiences, but getting into those customers, understanding their needs, understanding those industries, and integrating with their infrastructure, that takes time. And Amelia has 26 years of, they've accumulated 26 years of those customers and integrations. So it was mostly about acceleration, and there's a lot of complementary products.
I want to get your take, Kevin, about another theme we've talked a lot about on the show, which is that as we move through this earnings season, you think about AI. I mean, certainly if you were to talk about one of the prime drivers of the broader market rally we saw in the first half of this year, Kayvon, I mean, yes, it was the bet on the soft landing. It was also just the AI craze. This earnings season, it feels like something did shift, and investors suddenly just had more questions for more companies, where if you were spending a lot on AI, that was, suddenly investors want to know, okay, you're spending and there's testing and there's experimenting, but show me the usage, show me the monetization, show me the return. I'm just curious, Kayvon, how you've been in this business for a long time. How do you sort of think about that dynamic? Were you surprised by it?
So first, as someone who's been in this field for over 20 years, I can tell you that the technology of generative AI is real, it's magical, and it's going to change a lot of things. Now, there was a lot of focus on investment in the infrastructure of AI and foundation companies building foundation models. And some people, there's some chatter that maybe there's some overinvestment in those, which I don't necessarily agree or disagree with it. But what we think is going to happen next is companies building businesses and user experiences on top of this technology. So the analogy is we had iOS and Android in the mobile era, and that was the high for 1 or 2 years. And then for more than a decade, it was apps and apps and apps, and companies building these amazing apps, great businesses, value creation on top of that infrastructure. And we predict that the same is going to happen with AI. So there was infrastructure of AI. Now it's going to be companies that are building experiences on top of it. And SoundHound is a company that is building business at scale on top of these models and this amazing technology. So we are in cars, we've improved, we have reinvented existing experiences in cars and in customer service, and we're building new ones.
I'm interested, Kevin, people think, they do think, obviously voice assistant for cars, drive-through, and that drive-through at quick service restaurants. I've spoken to analysts before, Kayvon, they cover the company. Some of them, that's where they see a lot of runway for you all. I'm curious about the trends, themes you're seeing there.
Yeah, so there are things that we know will happen for sure. So in the near future, not far future, when you go to a drive-through of a quick service restaurant, you will be dealing with an AI, not the employee of the restaurant. The employees right now are doing multitasking. They're creating the food and they're packaging it, and they're also taking the order. And it's not good for them. It's not good for the user experience. And if you can automate that, and we can do that really well with AI, and we are in multiple brands, and the feedback is amazingly positive, that's going to happen, and that's a huge TAM. And what's even more special about SoundHound is that once we power the drive-thrus with our AI, because we also power cars, we can actually take your order before you get to the drive-thru, because you can when you talk to your car, you're talking to our AI. And if you discover those brands that we power, you can just talk to your car and order your food before you even get to the drive-thru.
Kayvon, your stock's up about 5% here in the after hours. So you reported, at least initially, your investors like what they see. Thank you as always, Kayvon, for taking the time to come on the show and chat.
Thank you for having me.
The unemployment rate might be signaling a recession, but jobless claims are not. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Well, at least that's according to one strategist. Well, as we talked about earlier, Josh, this week we don't have a lot of economic data. So this morning, the jobless claims took on some new importance as investors are trying to figure out what's going to happen next in the stock market and other risk markets and what's going to happen with the U.S. economy. Well, Kevin Gordon, senior strategist over at Charles Schwab, tweeted this chart earlier today. Now, first of all, what we're looking at here is the unemployment rate minus the 3-year moving average. And as you see, it actually is creeping up to an area that is consistent with past recessions, the 2020 recession, the financial crisis, and then you go back further. But he points out if you look at jobless claims and look at the 4-week average of initial jobless claims, the year-over-year percentage change, which is this axis here, you see that we're not seeing a spike there that would be consistent with past recessions. It's more sort of in line with norms here. We haven't yet seen that tick up. And of course, as we discussed, also the jobless claims figure this morning was somewhat reassuring to markets. As it happens, Kevin was on the morning show today, and he talked a little bit about why he is not convinced that a recession is coming.
A lot of these trends have been in place for a while, whether it's a slowdown in wage growth or whether it's this drift higher in the unemployment rate or even just the monthly change in payrolls, which has been decelerating. I think probably the miss in expectations for payrolls coupled with, that 20 basis point jump in the unemployment rate was probably where a lot of the fears started to kick in. But even if you look at some of the innards of the unemployment rate itself, triggering the SOM rule, yes, a bad thing. But if you start to look at things like the employment to population ratio, even for the prime age group, it's still rising. There's still a lot of inflows into the labor force and it's expanding. So those things are not yet consistent with what you would typically see at the beginning of a recession or the economy already being in a recession.
So another view here, Josh, looking specifically through the prism of the labor numbers at what kind of seems to be coalescing into consensus here among the people we've talked to, that there is an economic slowdown, but it doesn't yet look like a recession. At least that seems to be the majority view.
All right. Thank you, Julie. Coming up, we're going to check in on a few trending tickers that are moving after hours. Stay tuned. More asking for a trend on the other side. Rivian's second generation of its flagship lineup is ready for review. Yahoo Finance's Pras Subramanian and Rick Newman among the elite group. Wow, elite group. Look at that intro. To test drive one of the refreshed vehicles. They'll join us now to tell us more. Tell me more.
I'm not elite. Pras just showed up with the car. He's like, get in. I'm like, where'd this come from?
So, tell me the review. Is it? I mean, did it match an elite status? Did you feel elite?
You know, yes.
You did, okay.
Yes and no. So briefly, got the R1S, the SUV version of the R1 trucks that are selling quite well for Rivian compared to the truck was a world beater when it came out. The R1T was a great truck. I reviewed it. It drove phenomenally, but it's pickup, right? Most Americans want SUVs, so here we go. Here we have it here, and this is near Rick's place. I won't say where it is, but Rick, I want to talk to you about, design-wise, it's good, right? I think
it's very nice. Cool, and you do see Rivians on the road now, and they have that those distinctive. I mean, you've got the automotive language. How do you describe those?
Smiley face.
Oval.
What is it?
Yeah, it's I call it the anthropomorphized grill because it has
rolls
the
right
eyes.
Off the tongue.
It has the
Tom
eyes.
Rivian must love that.
So you can see the eyes, right? Like the ovals, right?
Yeah, that's what it is.
And I mean, you see them coming in the dark. They look very cool. So they've done a good job making this distinctive feature on the road. And remember, when they started, originally they got this deal with Amazon for the technology to go into delivery vans. So that was a huge bet in the technology by a huge player in the field, right?
Yeah.
So then we drive the SUV, and now Pras is the one who's
look at that live shot. There we go.
There we are.
Action shot.
Yeah. Look at everybody trying to get up and be in our cameras and stuff. I mean, the women just drive up next to us and they harass us. We have to swat them away.
You're at work. You've got a review to do. I'm sorry.
Okay, but Pras doesn't love the ride, and
what did you love the ride? What'd you think? You look very comfortable, I have to say.
I hate that class of. I hate big SUVs.
Why?
Because to me they're always willowy. They sort of just jumble down the road, and I'm just a guy who likes smaller cars, even if it's not a sports car, just a smaller car. My personal car is a Subaru crossover. So to me, all these big cars, Pras has a better basis for comparison because he did a detailed test of the truck. And this is
you like the truck.
So, yeah, I do. So real quick, I think there's issues with the fact that the way the car's tuned. The truck was longer, has a better, the weight is spread out better, and so that truck handles just like a dream. This car is
a dream.
This car is a bit bouncy. I found
it porpoises.
It porpoises front and rear.
Do you guys know what porpoising is?
Yeah.
Tell the world about porpoising.
It kind of goes up and down like this, and it's not great. We were able to dial it out a little bit. It got better, but it's not. It's tough for a $90,000 car. I just want to really add that this is a very important vehicle for Rivian because we only have two vehicles on sale: the R1T and the R1S before the R2s come out. So these cars.
This one isn't there. This one isn't there.
It's not there yet, but they do have software that can be updated over time. This can be addressed, but right now it's just not perfect.
All right, an elite team that was porpoising. That's what was happening.
Come porpoise with us someday.
I would love to. Rick, Pras, thank you both. Let's take a look at what's trending after hours now. Shares of Sweet Green on a tear. The salad chain raising its full-year outlook for same-store sales after a solid second quarter. Company's $184.6 million in revenue, beating estimates, though it posted a wider than expected loss for the period. Take-Two, take a look at that one. Taken off after hours, the video game publisher beating the street's first quarter estimates. Company's CEO saying he expects the acquisition of Borderlands developer Gearbox to be lucrative. The company provided no updates on its much anticipated Grand Theft Auto 6 release. Finally, Elf Beauty delivering a beat on the top and bottom lines for the first quarter. Company also boosting its adjusted earnings per share guidance for the full year. However, the forecast did miss Wall Street's expectations. And then take another look here, find shares of Paramount Global, which reported second quarter results. On the earnings call, company did announce it is laying off 15% of its U.S. workforce. Paramount reported its first ever profit for its streaming business in the second quarter, but overall revenue did miss expectations. That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.